So first of all, I want to say I'm thrilled that you're here joining us. My name is Jeremy Dodd, and I am absolutely so excited about this. Listen, I'm a certified financial planner, and I consider myself the quarterback of our financial team. I'm the one calling plays, keeping strategies aligned, and making sure that we stay focused even when markets blitz. And definitely, they have been bringing the pressure lately, I think. So I've got DMI's wealth management team on deck. We've got Mark Garcia, Kylan Bowen, and Brody Hasso. And I want to tell you why today's conversation matters so much to me. For the past 26 years, DMI Wealth Management Insurance Solutions has been guiding clients through market ups and downs. Sometimes it's calm, sometimes it's unpredictable, and occasionally downright chaotic. We've definitely seen all of it. We've grown into the largest registered investment advisory firm in our region, serving over 1,200 households with a team of 10 professionals and about $100 million in assets under management. Now, our goal is combining, top tier tech with something I think is even more important, and that's our core values. We value relationship, trust, teamwork, courage, and expert solutions. And here's why this is such a big deal to me. This is personal. We're a team, and we're bravely doing things that I think most firms are not even equipped to do. We're going to constantly train to be better at our craft tomorrow than we were today. And I think that all becomes especially important in today's market environments where headlines are swinging. I think emotions have been running a little high, and our aim is to bring structure, consistency, and discipline through everything we do. So that's the spirit of today's DMI Investment Mastermind. Today, we are pulling back the curtain on how we think, how we build portfolios, and how we are staying disciplined when the market is trying to knock us off course. So with that, I'm going to invite someone that's new for us to this webinar series, and it's Chief Investment Officer Ken Lambert. He's a certified financial analyst, over 31 years experience. And he is going to go into the deep dive on the framework and strategy we use every single day. He's going to walk us through the philosophy, and it is going to be fun, I promise. So with that, Ken, let's jump in.
Appreciate everyone being here today. I like things to be relaxed and not too formal. So I'm going to chat a little bit about how we work with the DMI team and our investment philosophy, and a bit of my background because it's unique as it relates to how we deliver investment management solutions or results for clients like yourself. Also, there's a lot going on in the markets, and so I'd love Q&A time and answer any questions everyone has, and I'm sure Brody will be able to logistically manage how we make all that work. But I'll spend a little bit of time chatting about my background as it relates to how we manage money and how our philosophy is fairly different, I think, from what I typically have seen in my career in Wall Street. And so I'll give you a little bit of that as well. A background on myself, I have, as Jeremy said, been in the business 31 years. I own a firm called Peavine Capital. We're based out of Reno, Lake Tahoe in northern Nevada. I've lived here my whole life. I grew up on a farm, actually outside of Sonoma as well, in Northern California, working with cattle, prunes, and walnuts. So spent my childhood earning a living. And so I grew up interested in the investment business. My grandpa actually, when I was born, gave me a cow. And then when they sold that cow for $5,000, my dad put it in the stock market. And then as a teenager, when I saw $5,000 turn into $20,000, I obviously became very interested in how that worked. And that began a love for the investment business. I was hired right out of college as the deputy chief investment officer for the Nevada Public Employees Retirement System. That's our pension fund, similar to Texas PERS or Texas Teachers. And I was in charge of basically managing the money for 150,000 Nevadans. The fund started at $6 billion, grew to $40 billion in my 20 years there. I was the chief investment officer for the last decade. And the unique part of the story is I managed money very differently than most institutions did. I did it very simply based on something what we call asset allocation, which is basically the most important decision you make is how much of your money do you put in stocks, bonds, cash, real estate, picking individual stocks, picking unique alternative investments, all the things Wall Street talks about all the time actually doesn't really move the needle long term in a diversified portfolio. Your risk and return is basically decided by how much money you have in stocks, how much you have in bonds, real estate, cash, and how you move those over time. That's the lever that really matters. And so I managed a very, very simply structured portfolio as the number two track record in the country. And about 14 years ago, I decided that as I learned how different what institutional investors, I'll call an institutional investor, anyone with over $500 million or $1 billion, again, my world, the average portfolio size was about 60 to 70 billion. The offerings and the opportunities they got were so different than what individual investors get. People with 2 or 3 or 400,000 or a few million or even 10 or 20 million. The Wall Street offerings were structured a lot more around complexity and fees and revenue than they were in results. And since the way I managed money for the pension fund was something that translated very well to smaller portfolios because of the simplicity of how I manage money, it was something that I knew could work well. I could take someone with $100,000 or $200,000 and say, I'm going to give you a $40 billion investment result, risk and return profile over time. And that's the genesis of Peavine Capital. And we're here, I kind of say we're the anti-Wall Street firm. A lot of what we do and the way we do it aligns well with what DMI does. It's basically for the people. It sounds sort of hokey, but no one actually does it, at least in my experience in this industry. And so it's something that we pride ourselves on. Every dollar of my family's personal money is invested right alongside of our clients. I often get people, they ask me, it's like, well, you do all this stuff for, clients in the business. What do you do for yourself? I believe if you have $1 million, $100,000, 10 million, 100 million, our largest individual client has a $120 million account. They get the exact same performance in that $120 million account as someone does in a $100,000 account. Good investing isn't based on the size of the portfolio. It's based on good investment philosophy, simple investment process, strong emotional management of the markets, pretty much basic building blocks that apply everywhere. So everyone in our investment stable, we have about a little over 1.1 billion in total assets right now that we oversee in a couple different risk levels. Everybody gets the same results. The way that we work with Jeremy and his team as a financial advisor, financial planning is a very different job from investment management. As a financial advisor or financial planner, the job is to work with each of you and figure out a couple of things. One is what we call the emotional and financial ability to take risk. Even though it doesn't feel that way, mathematically, an individual's financial life, financial goals, financial plan is fairly similar as to what a large pension fund does. You have a certain amount of money. You want to spend a certain amount of money in retirement. You want to grow that money at a certain level. So what you're solving for is statistically, what kind of return do you need over time, as well as how much risk are you willing to take? Now, in the institutional world, that risk level is purely financial based. How much can the portfolio move over time? What happens if the portfolio market value drops to a certain level? It's a math equation, which the DMI team is very good at calculating. But similarly, for individuals, you're different than institutions. Institutions have to follow what's called the prudent person rule, which means they must do what other institutions in a similar situation would do. They can't put all their money in Bitcoin, or they can't put all their money in a mattress in cash. They have to follow a certain set of industry standard practices as it relates to how much risk they take to achieve the return they want. In an individual, it's your money. No one tells you what to do. So you can override the risk levels however the heck you want. I have a client, he's a self-made man, actually built a casino and sold it in Nevada. And he has a very large net worth in the tens of millions of dollars and doesn't spend money. He could easily take a lot of risk financially, but emotionally he just doesn't want to do it. He goes, I just don't like seeing the portfolio value drop. So he's in our most conservative investment strategy, even though financially or mathematically he could be in our most aggressive investment strategy. So as the DMI team works with you to figure out, okay, how much money do we need to make for you to meet your goals and your life objectives? How much risk does that involve? And then how much risk can you handle? Days like today, are you freaking out when the market drops? Do you not care? Every individual is different, and there's no judgment as to whatever the feelings are. But once they figure out that risk and return goal, then my job is to generate the most return possible for the risks that we choose to take. And that's the hallmark of our firm from a results perspective, is we compare ourselves to other institutions and other investment managers in the country. Every quarter. You have something like 30,000 investment managers you could choose from, or investment management products. And we are in the top 1 to 2% of firms in the country in generating the most return for the risk that we take. There's a gentleman in the 50s and 60s at Stanford University. His name is William Sharpe. He created a statistic named after himself so he could stay famous, the Sharpe ratio. And that ratio is a calculation of what we call risk-adjusted return, how much return you made for the risk you took. And based on that Sharpe ratio comparison, we are among the best in the country, and that's what we pride ourselves on. All our returns are audited by a third party. So when we say our returns were whatever they were, when we say our national rankings were whatever they were, we have all the audits to back up that this is real data. We're not making anything up. And those things are really important to me to show credibility to our clients. So the next question you might ask is, how do we do that? And if I could simplify what we do, we focus on high quality, enduring assets, large cap United States companies right now, treasury bonds. We keep the portfolio extremely simple. I have the option to buy almost anything in the portfolio, small company stocks, China stocks. I can buy whatever I want. But typically we stay focused in a portfolio. Our stock portfolio looks a little bit like Warren Buffett's stock portfolio. Very simple, very high quality. There's a lot of statistical factor analysis reasons why what we call quality companies, or companies with high enduring earnings growth, tend to do better over time. So there's a lot of statistical reasons for what we do. But when you look at the portfolio, we own just a couple of what we call index funds that inside them is a lot of high quality treasuries and US stocks. So when you look at our portfolio, all our holdings fit on a single piece of paper. We only have 2 or 3 funds. It's extremely simple. Inside there's about 1,400 securities, so we're well diversified. But when you look at the portfolio, it's names you would recognize. It's not crazy alternative investments. It's not hedge funds. It's not derivatives. It's not options. It's not all the stuff you read about in the paper all the time. It's the stuff you would want your grandma's portfolio in, or your mom's portfolio, or a police officer or firefighter or teacher's pension. So it's very high quality, very simple. I rotate the portfolio, which I can chat in more detail if anyone's interested. As securities are cheaper and more expensive, we buy things as they get cheaper. We sell them as they get more expensive. Again, buy low, sell high. You hear a lot, but you don't see a lot. We actually do it. And I have charts and data from the past to back up. We have a history of doing that. And probably the key thing, kind of our competitive edge, is experience and emotional discipline. After 31 years of experience, we have this war in Iran right now. I've been through, I can't remember how many wars, managing money through the Iraq conflicts. Obviously 9/11 was managing money then. So I kind of jokingly say you want your investment manager to be the calmest person in the room. And the way you get to be the calmest person in the room is you do it for 3 decades. So tech bubble, financial crisis, the tech bubble bursting, the home loan crisis. I looked back once, I think I've been through 8 bear markets, the lowest one being a 45% drop in the S&P 500. So that experience creates emotional discipline. That creates a been there, done that feeling in the decision making on a day-to-day basis. And frankly, where I add value in the portfolio is being more emotionally disciplined experience than other market participants. So when markets drop, I buy from scared buyers. And when markets go up, we sell to enthusiastic buyers who don't really maybe understand how to look at the math of valuation and expensive and cheap the way we do. And then sometimes you're going to look like a moron. That's part of the business. There's a joke that if you're right 2/3 of the time, you're a genius in this business. So not overreacting when periodically we don't look so bright, and rinsing and repeating it. And sort of the last piece of the formula, and I'll stop and answer questions, is communication. So one of the things that I don't like about the investment business is it's very much structured around there's a bunch of Wizard of Oz geniuses on Wall Street that are doing things that you'll never understand. And so thank God you have them. And you don't know what your fees are and you don't understand what's going on in your portfolio. And they're like, trust me, this person's a master of the universe and it's a genius. And that's all BS. My whole career, I've managed money practically alone, making decisions in Northern Nevada, beating all those people because that story is not there to generate results. It's there to generate more fees and more complexity. And what we want to do is we want to empower you as an investor. So we're very focused on, I tell our clients every trade we make, every time we buy or sell something, I tell you what I did. Hey, bought stocks, here's why. Sold stocks, here's why. I'm doing nothing, here's why. And so over time, we want to empower you to make sure you know what's going on in your portfolio. Because when things get really bad, which they do once in a while, big bear markets, or maybe for a short period of time, our performance looks bad or dumb compared to the market, the other competitors, we want you to understand why we're here. We're here as a team. Our job is not to look amazing or have you think we're amazing. Our job is to make sure you have the money you want in retirement or the money you want to send your kids to college. Or I like to say that we're in the sleep at night business. So when you work with a team like us, the goal is that you don't think about your money. If you wake up in the middle of the night saying, "Oh my God, what happens if there's a war? Oh no, am I going to have enough money to retire?" You better be on the phone first thing the next morning and say, "Hey, I wasn't sleeping last night." Because I assure you the infrastructure is in place to make sure you sleep tonight. We have the kind of investment infrastructure between DMI and our firm that works for multi-$100 million clients. It's not a question of resources or expertise. It's a question of we didn't communicate it to you well enough to have you be comfortable. And so there's a system or a kind of a environment in place to take care of you. And it's backed by decades of experience. It's backed by the most sophisticated market knowledge that exists. It's backed by people giving a crap, frankly, and caring about you. And then our job on an ongoing basis is to communicate to you as your financial life evolves and as the market evolves, like today. And we have many, many, many clients with many, many, many success stories who have been doing this with me for a very long time. And so it's simply making sure that you are part of the system, understand the system, that your assets are invested properly within the process, and you're getting something, no matter what your account size is, that the most elite firms in Wall Street are getting, or the most elite clients in Wall Street are getting, if they know how to navigate the web of Wall Street. And so we've done that for you, and we're proud of it. And every client that I personally am pushing the button for buying and selling things, I think about. I've spent my life caring about 150,000 public servants and making sure that their retirement was taken care of and making sure they were comfortable. Again, running a big public pension fund, there's a target on your back every day within your state. And so when the governor wants to do something crazy in the fund or the legislature, I need to call on 150,000 people to say, I need you to protect me so I can do my job. And so we're all in this together. And simply, that's what this system is. It's not complicated. Usually the discussion is simply, wait a minute, it can't be that easy. Wait a minute, it can't be that clear. It can't be this simple. And it is. So mostly our job is to communicate that to folks like yourself and answer your questions. So with that, I'll stop, and we can go lots of places. We can answer questions, fill in details. I know someone on DMI's team might have questions too. So I'll pause there and see where everybody wants to take the chat.
Yeah, one of the questions that I actually had, Mom's in the chat. So hi, Mom, how you doing? She had a question just of why you do what you do, Ken. Whenever you wake up in the morning, is there like a specific, I want to beat the crap out of Wall Street, or, is there some other things of just why you do what you do?
I like that Mom's in the chat. Sound like we're playing Fortnite. I don't know. I love what I do. I love the fact that somehow or another God has given me a brainwave set that makes the markets pretty easy to follow and understand and make money from. And like I said, I grew up working on a farm. I used to pick prunes on my knees, and my grandpa would always be like, "Why you're going to go to college, boy?" And I grew up, I'm still, sometimes to my detriment in business, I'm still like a handshake guy. It's like, I don't know, yeah, I guess we're supposed to have a contract, but whatever. Like, let's look each other in the eyes and just understand. I just did a big window remodel in my house, and we didn't even sign anything. The guy just did it. And so I just, Wall Street is so built to confuse and make people feel uncomfortable and make money from people. And so I'm just kind of a farm kid who has this weird ability to sort of make investments simple and make money for people. And I love doing it. And so it sounds maybe kind of hokey, but it's really true. I just enjoy having people feel comfortable about the investment business and taking care of them. And I've built my business in a way that it scales really well. So all I do is manage money. I do have some direct clients I work with. I have about $500 million in assets for 7 clients, but I don't really take new business. There's some police and fire unions, so a couple very close families of mine. And so I stay close to the clients that way, but it's just really fun to be able to do the right thing for people.
I think that's exactly what one of the things that gets me up in the morning is just being able to show up for you guys, for my people, and that's our internal team as well as everybody that is that ultimately we're working for, which is all y'all. So my question I'm going to pivot to is I think there's a new breed of online stock picking. It's fueled, I think, by some really great digital marketing. It's not from necessarily the big wirehouses and things, but it encourages people to get involved in the stock market, which I think is fantastic on one hand, but also promises some huge returns. And ultimately, I see that as being a very feelings-based strategy. But I'd like your maybe comments on like the risk and return of this, what I see as, again, a new breed of stock picking online. I don't know if maybe you're tracking with what I'm saying on that. What do you think?
Yeah, I mean, it's like the internet, AI, all this stuff. It's like a gun. Like if you point it the right direction, it's extremely effective. You point the wrong direction, that's a problem. And so, I think AI, the internet, all these online discussions, how quickly things can go viral let's do prediction markets now, and let's do cryptocurrency. And That's both amazing and scary at the same time. And so what matters is you as an individual maximizing the resources available to you, which means sometimes ignoring things, sometimes accessing things. And there's been a theme through my career of this sort of computers will solve the investment solution. And there was a thing back in the day, this was mid 90s. Actually, no, I have my decade wrong. Early 2000s, like mid 2000s. There was a thing called quantitative investing. And so when I first started in the business, active managers would I remember this guy like Neil Eigen, he worked for a firm. He was like big, tall Polish guy, and he would just come in and pick stocks. He's like, oh, Home Depot's a good deal. And, we call them the stock jocks back in the day. And then there was this belief, no, that's not good. Computers are so smart. And so all the firms, Goldman Sachs, all the big companies, Morgan, everybody would create what they call these quantitative investment strategies. So they have these PhDs program computers to pick the stocks. And so they do all this historical analysis of, okay, these stocks do best in these environments, and they program the computer, and the computer would pick the stocks. And so I would always say, and they say, hey, this is amazing because the computer's making all the decisions. And I would always say, well, who decided what sort of set of decisions was going to be made? Like what data you gave it? Well, people. Okay. So, well, what would happen if the performance starts sucking? When do you stop trusting the computer? And so everyone's like, oh, we're not going to have that problem. And so I think it was 2005, maybe 2006, early 2006, there was something called the quant earthquake. I can't remember what the heck it was. And so all these strategies just sucked. And our pension fund had one of them because I was still transitioning some of the old school stuff that we had to the way I do it now. And Goldman Sachs was one of our managers. And so just as I had predicted, their performance was bad for so long. They came in suits and ties and limos and gave a presentation how they were reprogramming the computer because the model wasn't working correctly. So they were fixing it. And I'm like, okay, well, now we're back to humans again. And so all of these technology solutions, if you don't believe and own it and understand it and are willing to suffer through it when it's going to look dumb, now we're just back to humans. And so what's your conviction? How much do you own what you're doing? Do you understand what you're doing? Because there's a saying, Howard Marks is 79 years old. I used to work with him. He runs Oaktree, a very large private markets firm. And he has a saying that beware the 6-foot man that crosses the stream that's 4 feet deep on average. It's kind of a nerdy math joke, but he's a nerdy math guy. And you say, well, who cares? The 6-foot man, 4-foot stream, well, he's fine. No, the key is 4 feet on average. And so if you got that average depth by it's 3 feet and it's 5 feet and it's 3 feet, it's 5 feet, 3 feet, it's 5 feet, that average is 4 feet and the guy never drowns. But if you get the average by 2 feet, 2 feet, 2 feet, 20 feet, 2 feet, 2 feet, there's a point where that guy's not going to make it across the stream and we can't drown. And that drowning point could partially be a bad investment strategy, but it's also the emotional override. And so what's missing in this massive opportunity on the internet to invest, to make investment decisions, to do financial planning, what's missing is that human experience, emotional override of someone that's already made those mistakes before. So that's, again, it's a unique thing. I think it's cool. You can learn a lot from it. But if you're not emotionally ready to do it for 20 years, be careful because there's a deep spot in the stream. You don't know where it is.
I think that's a really great difference, I think, between DIY and what I'm calling DMI. We're trying to get that consistency and really hit an average depth instead of just falling off the edge.
Well, the investment business, I don't know if it's a folktale or if it's real. I think it's half real that somebody went back and Fidelity has something like 11 million accounts or something on its platform. And they went back and looked at what were the best performing accounts. And the best performing accounts, they kind of analyzed them, were of dead clients who hadn't touched them. So they didn't mess with them, and then the performance was better. And so people want investing to be exciting, but if it's actually effective, it's super boring. It's very unexciting. It is so much the turtle. It's slow and steady wins the race. If someone calls you and says, hey, I made 30% this year, 40%. I'm so excited. This is amazing. They could lose 30 or 40%. It works both ways. And so good investing is super boring and unsexy, and you shouldn't really be paying attention to it too much, because if you build it right, it's just like this perpetual money machine that just slowly chunks out money for you. And then 20 years later, you're like, where'd all this money come from? But if it's exciting in the short term good, it can be exciting in the short term bad.
I have a question from Carly. We read about people who trade frequently, and some appear to do well while others do poorly. What is your view on frequent trading as a revenue source or other reasons to trade frequently?
People trade well, let's talk about Wall Street. So big institutional solutions trade frequently for a few reasons. It's very hard to have an edge trading frequently. There are some firms that trade frequently, like Renaissance Technology, that aren't trading what we think of as stocks and bonds. They're basically running algorithms with server farms sitting right next to the New York Stock Exchange. There's a thing about the speed of the arbitrage of little trading in the way stocks trade. Sometimes they trade a little bit out of line, and so they'll do this, what's called high frequency trading. That is something none of us have access to. Renaissance's fee on that portfolio is 5% annually and 50% of the profits. That's a very different world than any of us would put our personal savings in. Usually Wall Street trades because it's entertaining and they say they're doing something. And they make themselves feel better. Believe me, when you're getting paid to manage someone's money and you don't do anything for a year, because you're actually paid to make decisions when you should, not just to make decisions all the time. If you're not used to that, that can eat at you. You're like, what'd you do this year? Nothing. And it's like there's a human desire. America's work ethic is like, I got to do stuff to earn your money, as opposed to be responsible to earn your money. Those are two different things. From my perspective, the way I trade in the portfolio is I only trade when there's something to make money off. And I only trade in a large enough size for it to matter. Most of the trades you see when your statement is, an inch thick and you're seeing all this trades and stuff all the time, you're trading something that's 0.5% of the portfolio. Even if you make a genius decision, you're not going to move the needle. I remember back in the day, this guy, Mark Anson, was the CIO of CalPERS. At the time, the California Pension Fund was like $200 million. He was making this huge press in the All Wall Street Journal about their inflation protection program. And I'm like, wow, I call him up. So what are you guys doing over there? And he's telling me all about it. And I said, what's your allocation to it? And he goes, oh, it's 1% of the fund. And I'm like, well, dude, like what? So typically I move a minimum of 5% of the portfolio. Sometimes I've moved 30% of the portfolio. When we had COVID hit, and there was that day in March where stocks dropped 15% in a morning, I moved 20% of everybody's portfolio in 5 minutes. I think, yes, there's absolutely revenue generation in the business. We don't have time for me to drag you through the sneaky way through agency trading. Morgan Stanley makes money, even though they say they're not charging you a commission. There's a pay for order flow, all the stuff behind the weeds. But it's usually entertainment, sometimes emotional entertainment, sometimes making a little revenue here and there. But in my opinion, it's always okay to do nothing. Like a lot of times I'll have a client who like just inherited a bunch of money or got a big windfall or sold their business. And I'm like, everyone and their brother is going to tell you need to do something with it. It's okay to literally sit on your butt for 3 months. Like it's literally okay. We're in this game for 30 years. So slow and larger moves, in my opinion, and I can mathematically prove it, add more value to the portfolio.
And we have another question here from Bill, and I feel like I already know kind of how you're going to answer this question, but it says, had a person mention 2008 and that another 2008 was coming. Not sure what that meant. Just curious about your understanding.
The 2008, I've heard that around. I think the odds of that are fairly low. I mean, we could see a 25% drop in the stock market. I'm not going to say that, even though, I mean, this war is super weird. I would have predicted flat-ish markets. When I say flat-ish, I say stocks down 5 or 10 or up 5 or 10, kind of floating around zero. A big bear market is down 20, 25. The 2008 financial crisis was down 45. But the thing about the financial crisis was people didn't think money was going to come out of the ATMs. Like the system broke. And the system broke because of all the home loan mortgage leverage and all the Big Short movie and all that kind of stuff. The government's done a pretty decent job of making sure that's hard to happen now. They've changed banking requirements. They've changed how the Federal Reserve steps in to support the economy. Private market loans and private equity is sort of a little dark spot in the business. But most of that is exposed to large institutions that can frankly take it. The problem before was we all had bank accounts at banks that over leveraged and kind of really screwed things up. So, I think you could definitely have shocks to the system, but I have a hard time seeing oh God, money's not going to come out of the ATM kind of environment like we had in 08.
2 more questions here. What are some of the hurdles newcomers may encounter that they may not have anticipated upon working with an investor/planner? Now, I think that can go to either Ken and Jeremy.
What are some of the hurdles? I think one of the key hurdles with working with a professional versus do-it-yourself is the decision of, are you going to trust the expert or not? Because you don't have to. Like you can change your own oil, or you can take it to the Mercedes dealer. Like it works either way, or the Ford dealer. There's a lot of things you can do yourself. And so if you've typically worked with just professionals and trust them to do the job, it's kind of like doing your own taxes versus having someone do your taxes. Then it's simply picking a professional you're most comfortable with. But if it's, hey, I've always done it myself, or I've never worked with someone before, what am I paying these fees for? What the heck are you guys doing? Maybe I should be doing it myself. It's sort of educating yourself on what are the pros and cons of setting it and forgetting it with a professional versus just say, hey, I'm going to roll myself. And what I typically see is that middle ground where people get I don't know if they get say confused. They get sort of uncomfortable. They're like, what am I doing here? And there's no right or wrong answer. I think it's just educating yourself on, if you're paying somebody to do this for you, make sure you don't think about it, because that's what you're paying for. I can mow my lawn, but if I pay someone to mow my lawn but then I critique all his lawn mowing, it's like, well, then go do it myself. And so it's an emotional decision of being comfortable with, do I see value here and do I see better results over time? That over time is a 3 to 5 year window. That over time isn't like tomorrow. And then relying on those people to be like, hey, you know what? I know you don't like manage the money, but I want to buy a rental home. And what do you think the math should be? And treating that person as a resource, just like your doctor or your cardiologist, then you're going to love that professional relationship. But if you're not sure where you're at on that, no harm, no foul. Just ask the questions until you're comfortable one way or the other.
Yeah. I would kind of add to that. We look at this like return on investment. Well, you're the biggest thing you own, right? You are going to go out and take risks, get jobs, make money, and that's gonna your return on your investment of work and effort and education are going to dwarf what I'm going to be able to do from a return percentage. So I'm going to be a pro at what I'm doing over here, which is managing assets, liabilities, big strategy, cash flow, where's money going to come from, and taxation. We partnered with Ken to be able to manage the risk of the market side and also give that wisdom and experience in there for pennies, relatively speaking. And so I think we become a good return on investment when we're leveraged correctly as professionals, whereas that releases you to go out and be the expert at what you do every day. We'll do this, you do that. You be great at what you do.
We have one final question here, and we'll wrap this up. This person's in their mid 40s, and they're just concerned about what's a good financial starting point? Is there even such thing as a good financial starting point? I know you deal with some clients that are, you said 120 million or 10 million, but say if somebody's just getting started, do they need to have a big chunk of money?
Albert Einstein, I think it was Albert Einstein, said the most powerful force in the universe is compound interest. But the thing about compound interest is it's super boring. And so there is this thing called the rule of 72. I don't want to be a math nerd, but to make it simple, if you make 7% a year on your money, every 10 years it doubles. So if you have $1 million, in 10 years it becomes $2 million. Well, what happens, especially for someone who's say 40, 30, 40, kind of mid ages, you look at the amount of money you're saving the first couple, 3 years, and you skip the lattes and you do all the stuff the financial planning people say is going to do to, kind of reduce your lifestyle in the short term to win for the long term. What happens is the first decade it seems super unrewarding and boring. And you're like, this sucks. I gave up all this stuff and I've got like $100,000. Like, who cares? But it's understanding, and what I would advise someone like you to do, or the questioner, is to talk with someone at DMI and have them show you one of the magical charts of what happens that says, I have $25,000 now, and I put $10,000 a year in for the next 20 years. But then I do, maybe I make even more money, so I put $15,000 a year, and then the chart goes like this. And so I have this with a lot of ultra wealthy clients I work with that are in their, say, 70s or 80s, when they had, $5 million, and they're like, oh my God, that's so much money. And they were very careful with it. But then 5 became 10, and 10 became 20. And then when you get that third decade, 20 becomes 40. And then I got some that are in their fourth decade that 40 becomes 80. And so you just got to start, and you have to live. That's the whole thing. Start and throw your statements away. It's not to throw your statements away to not pay attention. It's to get over the emotional hump of the first decade. This is just miserable, and I'm sacrificing, I'm getting nothing for it, until the flywheel of compounding happens. And then you turn around and you're like, oh my God, thank God I started in my 40s. Where would I be if I hadn't? And so one of the examples that we use in the public pension space is the average teacher in Nevada starting salary is $35,000 a year. And they get to maybe 50 or 60 in their long-term career. And about 20% of their pay is saved for retirement, right? And they start with, say, age 22. What's 20% of $35,000? Like $6,000, right? When that teacher retires in the public pension plan, the value of their pension is about $1.2 million, even though they never put in more than, even in the peak year, they're making $60,000. They're putting like $12,000, $14,000 in. But that compounding for a career adds up to these eye-watering numbers. And so trust compound interest and be patient, which sounds very boring again. But believe me, when you're sitting on your porch and you're 65 years old and you're drinking lemonade and you're like, damn, all right, I'm glad I did that. That's where the payoff happens.
This has been, just an amazing industry to be in. First of all, because I've personally felt like we have helped so many hundreds and hundreds of people, and I want to keep doing that for my entire career. I don't ever plan on quitting, but I am trying to make sure we bring up a team that is right behind me and becoming better at what we do all the time. And the industry, as Ken pointed out really well, it's been an explosion of complexity. And we are reversing course and going low complication, understandability, risk management within the numbers, and things that you can understand in real time. We want to make sure that that's what we deliver on this end of things. So with that, Ken, I deeply appreciate your time and This has been a lot of fun for me. I definitely nerd out over the math stuff. So what can you do? We can bring some more of that next time. So.
And if anyone has any other questions, just feel free to route it through your DMI advisor. I'm always available to answer any specific question anyone has. Just shoot me an email. I'll shoot an email right back directly. So don't ever hesitate to ask questions.
Thank you so much for everybody tuning into this live mastermind here. I'm going to drop a link in the chat if you want to set up a meeting with Jeremy, and then Jeremy can always shoot you over Ken's email so you can email him directly. Just again, thank you so much. This is the first of its kind. We'll definitely have multiple more with Ken and Jeremy. So thank you so much for watching this live mastermind, and I hope everybody has a great day.
Take care.